Right now, Rezolve AI PLC is trading at $5.13 per share, and it is getting hammered today, down a sharp 11.25%. On a day like this, the immediate reaction for most people doing some self-investing is to see that bright red number and assume the absolute worst. The market's expectation is clear. A double-digit drop signals a fundamental problem, a fatal flaw, or simply a failed enterprise. But the reality of what's happening with this stock is far more complex than just a simple sell-off. This isn't just noise, it's the sound of a highly speculative story colliding with the harsh mechanics of public market price discovery. And for anyone engaged in online investment, understanding that collision is critical. The volume we're seeing today is significant, suggesting this isn't just a few retail traders on the Robinhood app getting scared. This level of activity points to larger blocks being moved, perhaps by early investors or institutions reevaluating their position now that the company is out of the protective shell of its SPAC merger. The general belief surrounding any company that comes public via a SPAC, especially one with AI in its name, is that you are buying a lottery ticket. The narrative is one of massive asymmetric upside, the next big thing in technology that could reshape an industry. Investors hear about AI-powered mobile engagement and they picture a seamless, futuristic shopping experience. That's the story that was sold. But today's price action challenges that narrative directly. It forces us to ask a harder question. Is Rezolve AI an undervalued technology platform being unfairly punished in a risk-off market? Or was the initial valuation built more on hype than on a sustainable business model? The market is currently voting for the latter, but the truth often lies somewhere in between. Unlike the predictable, massive cash flows of a company like Apple stock or the established dominance of Nvidia stock in the semiconductor space, Rezolve is in its infancy as a public entity. Its value is almost entirely based on future potential, making its stock price incredibly sensitive to shifts in sentiment. What we are witnessing is not necessarily a verdict on the company's technology, but rather a fierce debate over what its future earnings are actually worth today. A debate playing out in real time on trading platforms from Fidelity to interactive brokers. Looking closer at the intraday movement, the selling wasn't a slow bleed. It was characterized by sharp, decisive drops. This pattern often suggests that programmatic selling or stop-loss orders were triggered, creating a cascading effect. For a small-cap stock like this, liquidity is a major factor. A few large sell orders can overwhelm the buy-side demand, leading to the kind of exaggerated downward move we're seeing. This is a classic risk for those using SoFi Active Investing or similar platforms to trade smaller, more volatile names. The bid-ask spread can widen, and what looks like a stable price 1 minute can evaporate the next. We need to consider the broader market context as well. When interest rates are uncertain and geopolitical tensions are simmering, institutional capital tends to flee from speculative growth stories and take refuge in safer, more established assets. A company like Rezolve AI, which is likely not yet profitable, becomes a prime candidate for portfolio managers to trim. This isn't necessarily a reflection on Rezolve-specific prospects, but a symptom of a market-wide reduction in risk appetite. The money flows out of speculative tech and into dividend-paying blue chips or government bonds. The performance of Tesla stock can often be a bellwether for this kind of sentiment. When it struggles, it often signals a broader aversion to high-growth, high-beta names across the board. So, what does Rezolve AI actually do? Stripping away the jargon, the company has developed a technology platform that aims to make mobile shopping incredibly easy. Imagine pointing your phone's camera at a product in a magazine, on a billboard, or on TV, and being able to instantly buy it or get more information without having to search for it online. Their platform uses a combination of image and audio recognition to create these triggers, turning any piece of media into a direct point of sale or engagement. The business model is primarily B2B. They partner with retailers, brands, and device manufacturers to integrate this technology into their apps and marketing materials. The revenue streams would come from licensing fees, transaction commissions, or a combination of both. It's a powerful concept because it seeks to eliminate the friction between seeing something you want and actually acquiring it. This is the core of their value proposition. The recent public listing came through a merger with Armor Acquisition Corp., a special-purpose acquisition company. This is a crucial piece of the puzzle because SPAC mergers have a complicated history. They provide a faster route to the public markets, but often come with baggage, such as shareholder dilution from warrants and a period of volatility as the initial SPAC investors and insiders become free to sell their shares. The current selling pressure could very well be a result of this post-merger lockup period expiring for certain shareholders. This is where an investor's choice of platform and tools becomes important. Someone using the basic Robinhood stock trading interface might just see the scary percentage drop. However, a more sophisticated investor using the interactive brokers trading platform would be analyzing Level 2 data, looking at the size of the buy and sell orders to gauge the real institutional pressure. They might be using advanced charting tools to identify potential support levels where the stock price might stabilize. Likewise, a long-term investor might be using their Fidelity brokerage account to slowly accumulate shares on down days like this, believing in the long-term story. They might even have it as a small speculative position within a diversified collection of Fidelity ETFs or Fidelity mutual funds. The approach to a stock like this varies wildly depending on your strategy, risk tolerance, and the investment help you might be getting, whether it's from a human advisor at Fidelity Wealth Management or an automated service like Schwab Intelligent Portfolios. These investing sites offer different levels of information and execution, which can lead to very different outcomes when dealing with such a volatile asset. Looking ahead, the future of Rezolve AI is a story of immense opportunity coupled with significant risk. The primary catalyst for the stock would be the announcement of a major high-profile partnership. If a global retailer like Walmart or a major smartphone manufacturer like Samsung were to announce the integration of Rezolve's technology, it would serve as massive validation. This would shift the narrative from a conceptual technology to a commercially viable platform with a clear path to revenue growth. Another potential positive would be the initiation of analyst coverage with buy ratings. Wall Street coverage would bring more institutional eyes to the stock, potentially stabilizing the shareholder base and providing more credible financial projections for the market to work with. These are the kinds of developments that could turn the tide and make today's 11% drop look like a historic buying opportunity. It's a high-stakes game of execution, and the management team is now under the full scrutiny of the public market. Every quarterly report will be dissected, and every metric on user engagement and partner adoption will move the needle. However, the risks are just as substantial. The most immediate risk is competition. The mobile commerce space is incredibly crowded. Tech giants like Google, Apple, and Amazon are all investing heavily in their own visual search and seamless checkout technologies. Rezolve has to prove that its solution is not only better, but also easier for businesses to integrate. Can a smaller, newly public company effectively compete with the boundless resources of big tech? That remains a huge question mark. Another significant risk is the path to profitability. The company is likely burning through cash to fund its growth, sales, and marketing efforts. In the current economic climate, the market has very little patience for companies that cannot demonstrate a clear and believable timeline to becoming cash flow positive. If the company has to raise more capital in the near future through a secondary offering, it would dilute existing shareholders and likely put further pressure on the stock price. This is the reality that tempers the optimistic AI narrative. While the technology is interesting, the business fundamentals have to work. Here's a question for everyone watching. Comment below what you think is the biggest hurdle for Rezolve AI to overcome: intense competition from big tech, or the market's current aversion to unprofitable growth companies. In conclusion, the brutal 11.25% drop in Rezolve AI PLC stock to $5.13 is a classic case of market expectation clashing with a much more complicated reality. The surface-level expectation is that of failure, a broken stock from a flawed company. But the deeper reality is one of a promising, albeit unproven technology navigating the treacherous waters of the post-SPAC public markets. It's a battle between a compelling story of frictionless mobile commerce and the market's unforgiving demand for financial results and a clear path to profitability. The selling pressure is real, driven by a mix of market-wide risk aversion, potential insider selling, and the inherent volatility of a small cap